Hello students and welcome back to bankexamstudy.com. My name is Ramandeep Singh and today we are going to discuss an important RBI circular, that is RBI's co-lending arrangements directions 2025. So let's start the session. Students, we have launched the IBPS RRB Scale 2 2025 course, in which we are providing courses for the GBO Scale 2, Scale 3, Marketing Manager Scale 2. So we are providing video classes, notes, quizzes, test series and power capsules in the course, right? So link to join the course is available in the description, and this is our WhatsApp number where you can ask your doubts and we are going to answer all your doubts, right? So let's start the session. So RBI's co-lending arrangements direction. First of all, you should understand what is co-lending. So when two banking partners, one NBFC, let's say, and one a commercial full-fledged bank, they combine hands, right? And they give one loan. So 20% is, let's say, financed by NBFC and 80% is financed by a proper commercial bank. That is a co-lending agreement, right? So what is the purpose? To improve the credit flow, share the risk between lenders and protect the borrowers. So Bank A and NBFC B, they jointly lend money to NBFC, not just for agriculture, for other purposes as well. Effective from 1st of January, these guidelines are effective from 1st of January, applicable to commercial banks, all India financial institutions, NBFCs, housing finance companies, right? So not applicable to consortium loans, multiple banking or syndications, right? A co-lending agreement, CLA, is a formal agreement between originating registered entity who source the loans and the partner registered entity who co-funds the loan, right? So for example, Muthoot Finance or Bajaj Finance, they gave, let's say, a 1 crore rupee loan to a borrower, right? And out of this 1 crore, 75 lakh is financed by, let's say, HDFC Bank. So HDFC Bank is a partner registered entity, right? So both of them, the originating registered entity and the partner registered entity, they share the risk and the return in the agreed proportions, right? So minimum retention requirement is there. So let's say the Bajaj Finance gave 1 crore rupee. Some of this loan risk is to be kept by the Bajaj, right? Bajaj Finance, right? That is minimum retention requirement. Each registered entity must retain at least 10% of every loan. So let's say it's a 1 crore rupee loan. Bajaj Finance should retain 10% of the outstanding amount, and the HDFC Bank in this case should retain 10% of every loan. This ensures that both these parties, they have skin in the game. This phrase is not used in the circular. I mean, just to explain you the concept, I'm using it. For example, a 50 lakh rupee loan given to an MSME, both parties, both NBFC and the bank, they should retain 5 lakh rupee, which is at least 10%. So at least 10% should be the minimum retention requirement. This is an important concept. Okay. Default loss guarantee. The originating registered entity may provide default loss guarantee up to 5% of the loan portfolio, right? So they may provide up to 5%. They can provide less than that. The borrowers, they are going to pay blended interest rate. So what is blended interest rate? So for example, the bank A lends at 10%, NBFC is lending at 15%, and their funding ratio is 20 to 80. So MSME is going to pay roughly 14% blended rate, right? So blended rate is a new concept used, right? So this is a method used to calculate the interest. So basically it is a weighted average. So funding ratio being the weights, right? And interest rates being the interest rate, right? So operational process, loan disbursement must go through escrow account. So no factor of trust here. the loan amount must go through an escrow account. For example, NBFC A, Bank B, they must deposit their money in the escrow account, and then the borrower is going to get money via that escrow account. Okay. So each registered entity must record its share within 15 days. Asset classification and reporting. So asset classification is done at a borrower level. So in case any borrower has gone NPA, it should be noted in the books of both parties, both lenders. In case of two lenders, it should be noted. If one registered entity classifies the loan as NPA, the other must follow the suit. Other must classify the NPA within 1 day. On the next day, the other party, the other NBFC or the bank, they must classify that particular loan as NPA. They get 1 day. So the loan documents must disclose each registered entity's roles, a single contact point for borrower, key fact statements. It should be disclosed properly on one sheet. So ban on cherry picking is there. Selective transfer of quality loans is prohibited. So that happened in the past. The banks were picking some of the loans from the NBFC. So selective picking of good quality loans is prohibitive. Any such transfer must follow transfer of loan exposure guidelines. So PSL treatment, if the co-lent loan qualifies for the PSL, each registered entity can claim PSL credit for its own share. So in their co-lending agreement, the funding ratio is there. According to the funding ratio, the PSL benefit would be given, right? Capital treatment, NBFC must deduct unrealized profit from capital until the loan matures, right? So unrealized profits must not be capitalized, must not be there in the books until the loan matures, right? So the question number 1, which of the following entities are not covered under the co-lending directions 2025? So these directions are not applicable to RRBs. But on commercial banks, NBFCs, all India financial institutions, so these directions are applicable. So it is repeated, but it should not be repeated. It is NBFCs. On NBFCs, these are applicable, right? Under the new RBI co-lending directions, each regulated entity must retain at least what a percentage of each loan on its books. So for example, you went to Bajaj Finance. So you went to Bajaj Finance for a loan of rupees 1 crore. So you got a 1 crore rupee from Bajaj Finance. And Bajaj Finance financed, let's say 70% of the loan, and 30% is, let's say, financed by IDFC, right? So they are co-lending. There is a co-lending arrangement between the Bajaj Finance and IDFC Bank, right? According to the new directions, each entity should be having 10%. Should be having 10%. This is the answer. They should be having 10% of the loan in their books. So if it is a 1 crore rupee loan, so if there are two parties, each of them should be having at least 10 lakh rupee or 10% of the loan in their books. So this is a very important question. Question number 3, under the RBI co-lending directions, what is the maximum default loss guarantee? As the name suggests, loss guarantee, default, in case of a default, some guarantees provided by the originator, right? So originating regulated entity, who's the originating regulated entity? So as a borrower, let's say I went to Bajaj Finance for the loan. So Bajaj Finance had the marketing or the sales team, which helped me getting the loan. So Bajaj Finance is the originating regulated entity. So in this case, they can provide up to 5% default loss guarantee, 5% of the loan portfolio. Question number 4, under the new RBI co-lending directions 2025, in a co-lending arrangement, how is the interest rate charged to the borrower? So you understood that you need 1 crore rupees and 70% is financed by, the ratio is 70-30. 70% is financed by Bank A and 30% is financed by Bank B. And interest rate of both these financial institutions is different, right? So interest rate is charged on the blended rate of interest basis, right? So blended rate based on proportion and cost of funds of each lender. So this is the proportion. This is funding ratio. Yeah, funding ratio is a good word. Funding ratio, let's say their interest rate is 9%. So its interest rate is 9.5%. So we are going to find out the weighted average, right? So funding ratios being weights. Under the new RBI's co-lending directions, if one registered entity classifies co-lent loan as NPA, the other must do within how many days? So Bank A, the Bajaj Finance, the originating lender, right? The Bajaj Finance, who sponsored 70% of the loan, IDFC sponsored 30% of the loan. So that loan goes NPA and IDFC classified that loan as NPA. Within how many days Bajaj Finance should classify the loan as NPA? So Bajaj Finance has only 1 day to classify the same loan as NPA because this is the same book, same loan. Bajaj Finance gave 70% of the sponsored 70% of the funds. IDFC sponsored 30% of the loan, right? 1 working day. Which of the following practices has been explicitly prohibited under the new RBI co-lending framework? Cherry picking. What do you mean by cherry picking? Let's say an NBFC is giving small micro loans to the public, right, to its borrowers. There are certain borrowers whose CIBIL is, let's say, 750 plus, and there are borrowers whose CIBIL is around, let's say, 500, 550, right? So the banks cannot do cherry picking. The banks, they cannot pick the good loans. I mean, they are, the HDFC Bank is coming to this NBFC and HDFC Bank is buying only the good loans. So it is prohibited. CLM2 model is prohibited. Cherry picking of good loans is prohibited. That's all for today, students. I hope you like the today's session. IBPS RRB Scale 2 2025 course is available on bankexamstoday.com, in which we are covering the entire syllabus. This is our WhatsApp number where you can ask your doubts and we are going to answer all your doubts. List of our successful students in the past. All these students, they took our courses in the past and they cracked their respective exams. And I'm really, really happy for them. You can be one of them. So IBPS RRB Scale 2, Scale 3, 2024, 2025 students. All these students, they took our courses and they cracked their respective exams and I'm really, really happy for them. You can be one of them in the future, and yes, you are going to be one of them in the future. And that's all from my side. Thank you and have a very nice day. Bye-bye. Subscribe the channel and like this video because that's really, really important for me as well. Thank you and have a very nice day. Bye-bye.